Welcome to Venture Capital, How It Works. I'm your host from the Founders Intel channel, and in today's episode, we'll be diving into one of the most difficult steps in your entrepreneurial journey, raising pre-seed and seed capital. In this episode, we'll cover the various options available for founders at these early stages, from crowdfunding to accelerators, incubators, and angel groups. We'll provide a detailed look at what each option offers, what they typically don't provide, and how to decide which is the best fit for you. Whether you're just getting started or preparing to scale, this guide will help you navigate the often complex world of early-stage funding. Before we get into the specifics of funding sources, let's clarify the difference between pre-seed and seed capital, as these terms are often used interchangeably, but they represent different stages of a company's growth. Pre-seed funding is generally the very first capital a startup raises. It's usually sourced from personal savings, friends, family, or early supporters who believe in your vision. The amount can vary, but typically ranges from $50,000 to $500,000. The purpose of pre-seed capital is to develop a minimum viable product, validate your idea, or build a small prototype. At this stage, your focus is on proving that your idea has potential. On the other hand, seed capital is the next step, once you've gained some initial traction. This could be in the form of users, early revenue, or significant interest from potential customers. Seed funding is often used to scale your business, hire a small team, and refine your product based on user feedback. Typical seed rounds range from $500,000 to $2 million. Understanding where your startup falls on this spectrum is crucial because it will influence which funding options are available and appropriate for you. One of the first options founders often consider in the early stages is crowdfunding. Platforms like Kickstarter, Indiegogo, and equity crowdfunding sites have gained significant popularity in recent years. Crowdfunding works by presenting your business idea directly to the public. Potential backers can contribute small amounts in exchange for rewards, early access to your product, or in the case of equity crowdfunding, a stake in your company. For pre-seed startups, crowdfunding can be a great way to not only raise capital, but also build a community of early adopters and supporters. It allows you to validate your product in the market and generate buzz even before it's fully developed. However, there are a few important considerations. Crowdfunding campaigns require a great deal of preparation and effort. You'll need a compelling video, clear messaging, and a well-thought-out reward system or equity offering. Marketing your campaign is essential, as success often depends on your ability to drive traffic to the platform. What it provides: capital. Depending on the platform and the success of your campaign, you could raise anywhere from $10,000 to $500,000. Validation. Successful campaigns serve as a strong market validation for your product. Community crowdfunding helps you build a community of early supporters and potential future customers. What it doesn't provide: structured mentorship. Unlike accelerators or incubators, crowdfunding doesn't come with built-in mentorship or guidance. Guaranteed success. It's important to remember that many crowdfunding campaigns fail to reach their goals, often due to poor marketing or unrealistic expectations. Accelerators are another popular option for early-stage startups, particularly those in the seed stage. Accelerators provide a structured program designed to help startups grow quickly, offering mentorship, funding, and access to a network of investors and successful entrepreneurs. Programs like Y Combinator, Techstars, and 500 Startups are well known for their intensive, cohort-based model, typically lasting between 3 to 6 months. These programs offer anywhere from $50,000 to $150,000 in exchange for 5 to 7% equity in your company. The primary value of an accelerator lies in its network. You'll receive mentorship from experienced founders, gain introductions to potential investors, and benefit from being part of a community of other startups going through the same challenges. Many accelerators culminate in a demo day, where you'll pitch your business to a room full of investors. What it provides. Mentorship accelerators offer direct access to experienced mentors who can provide guidance on product development, business strategy, and scaling. Network. Being part of a top accelerator opens doors to investors, potential customers, and future partners. Structure. The program is designed to push startups to achieve specific milestones within a short time frame. What it doesn't provide, large amounts of capital. While accelerators provide some funding, the primary value lies in the mentorship and networking opportunities. Long-term engagement. Once the program ends, you may no longer have access to the same level of mentorship and support, so it's important to maximize the time you have. If accelerators are designed to rapidly scale startups, incubators are more focused on nurturing an idea from its earliest stages. Incubators offer a supportive environment where you can work on your product, refine your business model, and conduct market research. Incubators usually offer co-working space, basic resources such as legal or accounting services, and access to a network of mentors and industry experts. Unlike accelerators, incubators typically don't have a strict time frame, and you could be part of an incubator for a year or longer. Incubators are ideal for founders who are still refining their idea or working on an early prototype. The funding provided by incubators tends to be smaller, anywhere from $10,000 to $50,000, but the emphasis is on helping you build a solid foundation for future growth. What it provides. Supportive environment incubators offer a slower-paced, long-term approach to business development. Access to resources. Many incubators provide essential services such as legal advice, accounting, or technical support. Mentorship. Similar to accelerators, incubators connect founders with experienced mentors and industry experts. What it doesn't provide? Significant capital. Incubators provide less funding compared to accelerators and angel groups. Pressure to scale quickly. While this can be a benefit for some founders, those ready to scale may find the slower pace of incubators limiting. Now let's talk about angel groups and networks, an essential source of funding for both pre-seed and seed stage startups. Angel groups are collectives of high net worth individuals who come together to pool their resources and invest in promising startups. Unlike individual angel investors, angel groups operate in a more structured way, often with a formal review process and decision-making meetings. Angel groups like Tech Coast Angels, Golden Seeds, and New York Angels are organized to help de-risk investments by distributing capital across several members. These groups can invest anywhere from $100,000 to $1 million, depending on the opportunity, and typically take equity in return. One of the advantages of angel groups is that they bring a wealth of collective experience and connections. Many angel group members are former entrepreneurs or industry experts, which means they not only provide capital but also valuable insights and mentorship. Additionally, by engaging with an angel group, you're gaining access to a broader network of individuals who can offer further introductions to potential investors, customers, and partners. Angel networks operate similarly, though they tend to be more loosely organized. Members may share deal flow but invest individually rather than collectively. Examples include the Angel Capital Association or groups within local communities. What they provide, substantial capital angel groups are capable of writing larger checks than individual angel investors, which can be crucial for seed stage startups. Mentorship and advice. Many members of angel groups are seasoned entrepreneurs or professionals who offer mentorship and strategic guidance in addition to their capital. Network access. Being funded by an angel group can also open doors to further investment opportunities down the line, including venture capital firms. What they don't provide. Uniform investment processes. Since each angel group operates differently, the speed of investment decisions, the level of involvement, and the specific terms of the investment can vary widely. Some groups may take longer to come to a decision, while others might move quickly. This can be frustrating for founders who need capital urgently. Large-scale funding. While angel groups can provide significant capital for pre-seed and seed rounds, they generally don't have the capacity to fund later-stage growth rounds, which is where institutional venture capital often steps in. Now that we've explored the different funding options, crowdfunding, accelerators, incubators, and angel groups, How do you decide which one is best for your startup? It really depends on several factors: the stage of your business, the type of support you need, and the timeline you're working with. If you're in the very early stages, still validating your idea or developing a prototype, crowdfunding or joining an incubator might be your best options. Crowdfunding helps you build early market interest, while an incubator offers a nurturing environment to refine your business model without the pressure to grow too quickly. If you've already built an MVP and are ready to scale but need hands-on guidance and a network of potential investors, accelerators are ideal. These programs are designed to push you forward rapidly with structured milestones, mentorship, and networking. However, be prepared for the intensive pace and competition. Finally, if you're looking for larger investments and long-term strategic guidance but prefer a bit more flexibility than what accelerators provide, consider approaching angel groups or networks. These collectives offer both funding and mentorship, but with more flexibility and potentially longer-term involvement than accelerators. Remember, you don't have to pick just one path. Many founders combine these approaches, perhaps starting with crowdfunding, moving into an accelerator, and then securing angel group backing. The key is to be clear about what stage you're at, what you need most, and where you see your business going. Securing pre-seed or seed capital can be a daunting process, but it's also an exciting opportunity to bring your vision to life. Whether you're seeking to validate an idea, build a community, or raise significant funds to scale your company, the options we've discussed offer a variety of paths to help you succeed. As a founder, it's essential to research each option thoroughly, weigh the pros and cons, and most importantly, engage with the right partners who align with your long-term vision. The right funding decision can set you up for future success, not just in terms of money, but also in terms of mentorship, network access, and overall strategic growth. So, as you continue on your entrepreneurial journey, remember that you don't have to go it alone. Whether through crowdfunding, joining an accelerator, or working with angel groups, there are resources and communities ready to support you. And if you're looking for more insights on this topic, be sure to visit our website at foundersintel.com for additional resources and guidance. Thanks for watching, and if you found this video helpful, smash that like button and subscribe for more VC news, insights, and profiles.